There is a force in the universe more powerful than gravity. It is invisible to the naked eye, yet it builds empires, destroys debts, and creates dynasties. Albert Einstein, the smartest man who perhaps ever lived, reportedly called this force the eighth wonder of the world. He said, "He who understands it, earns it. He who doesn't, pays it." Most people spend their entire lives paying it. They are the victims of this force, but a select few, the wealthy, the free, the owners, they have learned to harness it. Today, we are not just going to talk about math. We are going to visualize the magic. We are going to tell the story of two brothers and a single grain of rice to show you how time can turn a few dollars into a fortune. Welcome to the story of compound interest. Ready to build your passive income fortress? Hit the subscribe button and let's rewrite your financial story. To understand the future of your money, we must first look into the past. There is an ancient legend about the inventor of the game of chess. When he presented the game to the Emperor of India, the emperor was so delighted that he offered the inventor any reward he wanted. "Name your price," the emperor said. "Gold? Jewels? Palaces?" The inventor was a humble and wise man. He pointed to the chessboard and said, "Your Highness, I only ask for rice. Place 1 grain of rice on the first square of the board, then 2 grains on the second square, 4 on the third, 8 on the fourth. Just keep doubling the amount for all 64 squares. That is all I ask." The emperor laughed. He thought the inventor was a fool. "Such a small price for such a great game," he shouted. He ordered his treasurer to pay the man immediately. The treasurer started placing the grain. Square 1, 1 grain. Square 2, 2 grains. Square 3, 4 grains. By the time they got to the 10th square, there were only 512 grains of rice. It was barely a handful. The emperor was still smiling. He felt he had made the deal of a lifetime. But then, something terrifying began to happen. By the 20th square, the number had grown to over 1 million grains. The handful had become a large sack. By the 30th square, the sacks filled the entire room. By the 40th square, they needed a warehouse. And by the last square, the amount of rice was larger than Mount Everest. It was more rice than existed in the entire world. The emperor realized, too late, that he had been tricked by the explosive power of exponential growth. He didn't understand that the end of the curve is always faster, steeper, and more violent than the beginning. Now, you might be thinking, "Eduardo, that's a nice fairy tale, but I don't trade in rice. I trade in dollars." You are right. So let's bring this magic into the real world. Let me introduce you to two brothers, Jack and Tom. Jack and Tom are identical twins. They grew up in the same house, went to the same school, and got the same job at the same time. But they had very different philosophies about money. Jack was the impatient one. He wanted to live life now. He bought the new car. He went to the parties. He told himself, "I'm young. I'll start investing when I'm older and making more money." Tom was different. Tom understood the chessboard. At age 25, Tom started investing $500 a month into a standard ETF that tracked the S&P 500. He didn't do anything fancy. He just automated it. $500 out of his paycheck? Gone. Planted into the market. He did this for 10 years. When Tom turned 35, he had a life crisis. He lost his job. He had to move, and he couldn't afford to invest another penny. He stopped contributing completely. He never added another dollar to his account. He just let the money sit there, growing on its own until he retired at age 65. Are you already investing in ETFs or just getting started? Drop your comment below so we can discuss it. So, let's do the math. Tom invested for 10 years, $500 a month. That means he put in a total of $60,000 of his own hard-earned cash. Now, let's look at Jack. At age 35, Jack finally woke up. He saw that his brother Tom had a nice nest egg and he felt behind. Jack said, "Okay, playtime is over. I'm going to catch up." So at age 35, the exact year Tom stopped investing, Jack started. Jack was determined. He invested the same $500 a month, and he didn't stop. He invested every single month from age 35 all the way to age 65. Jack invested for 30 years straight. Tom only invested for 10 years. Jack put in a total of $180,000 of his own cash, 3 times more than his brother. Who do you think won the game? Who had more money at retirement? Most people would bet on Jack. After all, he worked harder. He saved longer. He sacrificed more. But the universe doesn't care about effort. It cares about time. When they opened their accounts at age 65, assuming an average market return of 8%, the results were shocking. Jack, the hard worker who invested for 30 years, had approximately $745,000. Not bad. He is comfortable. But Tom, the lazy brother who stopped investing 30 years ago, Tom had over $787,000. Think about that for a second. Let it sink in. Tom invested $60,000. Jack invested $180,000. Tom did less work. He put up less money. He spent 30 years adding nothing. And yet, he ended up with more wealth than his brother who hustled for 3 decades. How is this possible? Was the system rigged? Did Tom get lucky? No. Tom simply had the 8th wonder of the world on his side. Tom's money had more time to have children. You see, compound interest is not just interest. It is interest on interest. In the beginning, your money grows slowly. This is what we call the valley of disappointment. In year 1, you invest $6,000. You make $480 in profit. You look at it and say, "Is this it? I can't retire on $480. It feels pointless." This is where 90% of people quit. They sell. They buy a car instead. They kill the seed before it becomes a tree. But if you wait, something magical happens around year 7 or year 10. Suddenly, you aren't just earning interest on your original savings. You are earning interest on the interest you earned last year and the year before that. Your money starts to multiply like the rice on the chessboard. In the story of the brothers, Tom's money had those first 10 crucial years to double and double again. Those early dollars are worth exponentially more than the dollars Jack invested later in life. A dollar invested at 20 is worth more than $10 invested at 50. This is the brutal truth of the time value of money. Time is not just money. Time is the multiplier of money. This brings us to the visual concept of the hockey stick curve. Imagine a graph. On the bottom is time. On the side is wealth. For the first few years, the line is flat. It looks like nothing is happening. It's boring. It tests your patience. It tests your faith. But then it hits the knee of the curve. The line turns vertical. It shoots up to the moon. The tragedy of the modern investor is that most people interrupt the curve right before the explosion. They get impatient. They try to time the market. They pull the money out to buy a liability. When you pull your money out, you aren't just spending the cash. You are killing the soldiers that were fighting for your freedom. You are destroying the rice before it reaches the 64th square. So, what is the lesson here? What does this mean for you watching this right now? If you are young in your 20s or 30s, you have an advantage that Warren Buffett doesn't have. You have time. You don't need a high income to become a millionaire. You just need consistency and patience. You are standing on the first square of the chessboard. Don't waste it. If you are older in your 40s or 50s, you might feel discouraged by Tom's story. You might think, "I missed the boat. It's too late for me." Listen to me. It is never too late. But the strategy must change. You may not have 40 years, but you have today. The best time to plant the tree was 20 years ago. The second best time is right now. You cannot get back the lost time, but you can stop losing more time starting today. Compound interest is the great equalizer. It doesn't care about your family name. It doesn't care where you went to college. It doesn't care how smart you are. It is pure, cold, beautiful math. It rewards patience. It punishes impulse. The bank knows this secret. That's why they want you to keep your money in a savings account earning 0.1% while they lend it out at 7%. They are using the chessboard against you. It's time to flip the board. It's time to stop working for every single dollar and start building an army of dollars that work for you. It's time to respect the grain of rice. If you want to learn exactly where to put that grain of rice, which ETFs to buy, which accounts to open, and how to build that portfolio that grows while you sleep, that is exactly what we do on this channel. My name is Eduardo, and here, we don't just save money, we build wealth. Don't let another day pass without planting your seed. The silent thief of inflation is waiting, but now, you have the weapon to defeat him. Ready to live off dividends? Click the next video to discover top dividend and growth ETFs right now.